Hello friends, welcome to our channel Accounts and Finance with FARSK. This is our series on the set of videos on reading the financial statements, 1 of 7, financial reporting. Hope you will like, share and special request to all to don't forget to subscribe our channel. Well, what are these financial statements? And how is it relevant or important for us? We will know all in the coming videos. These following set of videos explains how to read and interpret the financial statements of a business enterprise. The purpose of the financial statements of a company is to provide information on the profitability and economic well-being of the organization. Accounting and the corresponding financial statements are the language of business and allows business owners, investors, bankers, creditors, and others to understand how the business is doing. Every day, hundreds of financial transactions takes place in the normal course of the business, and without some mechanism to compile and organize the transactions, there would just be a mind-numbing jumble of data. To bring order to this chaos, accountants developed standard reporting guidelines for business data. The guidelines allows us to summarize a large number of transactions into groupings of similar transactions. The standard reporting format includes three primary reports: the balance sheet, the income statement, and the statement of cash flows. Sometimes other reports are included, such as a statement of retained earnings. We will analyze each of the above-mentioned basic financial statements in detail, as well as other statements and key indicators of the financial well-being of the company. One of the advantages of standard reporting formats is that the financial results of a company can be evaluated on a comparable basis with other companies, since they are all using the same basic reporting format. The process of compiling financial data includes recording a business transaction, classifying the transaction, posting a transaction to the appropriate ledger account, and summarizing the ledger accounts. Now, what is posting? When we are talking about posting to a ledger account, what's the meaning of posting? Well, posting is an accounting term that means to transfer the accounting entries from a journal into a ledger book in the order in which they were generated. Ledger is an accounting term that is used to describe a book of accounts in which data from transactions recorded in journals are posted and thereby classified and summarized. Business transactions falls into five main accounts in the balance sheet and income statement, and they are as follows: assets, liabilities, shareholders' equity, revenues, and expenses. In addition to these five main accounts, accountants develop a chart of accounts for their particular business. For instance, in the asset account, the accountant will likely include accounts for cash, accounts receivable, and prepaid expenses, among others. For the expense accounts, the accountant may be including in the chart of accounts rent expense, depreciation, payroll expenses, etc. The chart of accounts for this course will be shown momentarily or a period in time. The accounts. Assets, liabilities, shareholders, equity, revenues, and expenses are the main categories in the balance sheet and the income statement. Sub-accounts in these categories are listed in the chart of accounts. The balance sheet will list all balances in the asset, liability, and shareholders' equity accounts. The income statement will list the balances in the revenue and expenses accounts. A balance sheet must always be accompanied by an income statement to get a true financial picture of the business. On the balance sheet, assets are always listed first, followed by liabilities and then shareholders' equity. In some financial statements, the balance sheet is organized with the asset on the left side of the page and the liabilities and shareholders' equity on the right side of the page. Another form is to show the assets followed by the liabilities and shareholders' equity all in one column. Either approach is acceptable. Income statement reports the revenues for first followed by the expenses in a columnar form. One important distinction between the balance sheet and the income statement are the reporting periods. The balance sheet reports the assets, liabilities, and shareholders' equity as on a particular date, such as 31st December 2024. Whereas the income statement, on the other hand, reports revenue and expenses for a given period of time, such as for the period from 1st January 2024 to 31st December 2024. While discussing the balance sheet, we need to mention the different forms for the shareholders' equity. Well, shareholders' equity is the portion of the amount in the company that is owned by the shareholders. For a sole proprietorship or partnership, this account may be called owner's equity or partner's capital. In general, it is called as shareholders' equity. Therefore, we will use the same term. GAAP also requires a statement of cash flows to accompany the balance sheet and the income statement to fully reveal the financial condition of the business. The purpose of the statement of cash flows is to show the inflows and outflows of cash of the company. Since financial statements are usually based on accrual accounting procedures and not on cash accounting procedures, therefore it may be difficult to really understand how much the cash the business is actually generating. For instance, the income statement may show a strong profit for a given month or a period due to great sales. But since many sales are on terms of credit, the actual cash may not be collected for another 30 to 90 days, if at all, and this usually happens in the contracting business or even in the trading business. The statement of cash flows helps the business owner to understand where his cash is coming from and where it's going. The cash flow statement can also be misleading though. If the business decides to sell a major subsidiary, it may generate a great deal of cash, but the cash is temporary and will not be sustainable. It takes all the three statements, the balance sheet, the income statement, and the statement of cash flows to get a true picture of the company's financial condition. The statement of cash flows is divided into three sections. The first section shows cash generated by the normal operation of the business, such as customers paying for the items they have purchased. The second section covers the inflows and outflows of cash from investing activities, such as buying and selling real estate and buildings or making investments. The final section involves financing activities such as receiving cash from investors and from loans. Another document that is frequently part of the financial statements of a business is a statement of retained earnings. This is a simple doc- this is a simple document that links the income statement to the balance sheet. The net income shown on the income statement will flow to the balance sheet as retained earnings under the shareholders' equity section, less any dividends paid out during the period. The statement of retained earnings shows how much of the net income was distributed as dividends and how much was retained on the balance sheet. Since net income can sometimes be a loss or a negative number, the retained earnings on the balance sheet may decrease instead of increasing. Coming up in next videos, reading a financial statement, balance sheet, income statement, statement of cash flows, ratios, statement of retained earnings, financial analysis. Well, that's it for today. Hope you'll like our video. For more videos, please do not forget to like, share and subscribe our channel. Accounts and Finance with FARSK. Thank you. Have a great day.